Warren Buffett is worth $150 billion, and he built the majority of his fortune through stock picking. But did you know that in his will, he advises that his wife and his heirs skip stock picking entirely and just invest in 2 funds instead? Well, it's true. And by the end of this video, you'll understand exactly why Buffett recommends a simple 2-fund portfolio for his wife instead of stock picking. Hey, my name is Brian Feraldi. If you're new here, I've been studying super investors like Warren Buffett for more than 20 years. In this video, we'll dive into what these 2 funds are, why they're so powerful, and how they can help you avoid the most common investing mistakes. So what exactly are these 2 magical funds? Buffett spilled the beans in his 2013 annual letter to Berkshire Hathaway shareholders, where he shared his exact investing estate plan for his wife following his death. In that letter, Buffett shared the only 2 funds that his wife will ever need. The first is the S&P 500 Index Fund. Funds like this own a tiny piece of the 500 largest and most profitable companies in America. And Buffett says that owning this type of fund is like buying a slice of the entire American economy and betting on its continued growth and prosperity. Now, the second fund in Buffett's simple strategy is a short-term government bond fund. This fund is the portfolio's safe haven that invests in very low-risk government debt, which provides stability and income that helps preserve the portfolio's capital, especially when the stock market gets bumpy. Now, how much does Buffett suggest investing in these 2 funds? Well, he recommends that his heirs put 90% of their money into that low-cost S&P 500 index fund, and the remaining 10% should go into short-term government bonds. Now, that allocation could not be simpler to follow, yet if you unpack it, it should deliver solid long-term returns. Now, how much should these funds return over the long term? Well, let's take a look at Jeremy Siegel's fabulous book, Stocks for the Long Run, for some clues. In that book, he shares this wonderful visual, which shows the total real return for different asset classes over a 200-plus year period in the United States. Notice that stocks representing the S&P 500 have delivered an annualized real return of about 6.9% over the 200-year history. Government bonds have delivered a total real return of about 3.6% over that same long-term time horizon. So if history is any guide, then we should expect that this portfolio should deliver a real total return of about 6.6% moving forward, which is really solid, especially given that this number is after the effects of inflation. Buffett suggested using index funds to build this portfolio, but it's worth pointing out that index funds are not as convenient to buy and own as ETFs, and it's entirely possible to use ETFs to achieve this same portfolio construction. Now, I made a few visual cheat sheets and put them into an ebook that spells out the exact ETF fund names that you can use to construct this portfolio, depending on which broker platform you use. If you want a free copy of that ebook cheat sheet, just visit longtermmindset.co/ETF or click the link in the video description and let me know where to send it. Now, this portfolio is so simple, it might seem too good to be true, right? Well, here's why Buffett believes that this simple 2-fund portfolio is all his heirs need to do to successfully beat actively managed complicated portfolios over time. The first reason Buffett expects this simple strategy to work so well is because its costs are so low. Index funds and ETFs generally have rock bottom fees compared to actively managed funds. And over time, those lower fees translate directly into more money in the investor's pocket thanks to the power of compounding. This visual by Vanguard explains exactly why. Let's assume you have a $100,000 portfolio that earns a 6% return over time. If you pay a 0.6% annualized fee, you'll have $497,000 after a 30-year period. That's pretty good. However, if that annual fee was lowered to just 0.15%, you would have $70,000 more. That's a great example of the power of keeping your costs low and the importance of focusing on fees when compounded over multiple years. Now, the second big advantage here is behavioral. By turning this into a set it and forget it portfolio, it discourages Buffett's heirs from having to constantly worry about timing the market with strategic buying and selling. Buffett has taken the guesswork out of the process entirely with these simple instructions. And as Buffett says, the stock market is a device for transferring money from the impatient to the patient. So following this simple 2-fund strategy helps his heirs, and you, if you're following it, to remain patient. After all, knowing what to do is one thing, but actually doing it consistently in the real world can be a huge challenge. Now, Buffett's strategy was very simple, But it's important to remember that Buffett's wife and his heirs are already super wealthy, so they can afford to be more aggressive with their asset allocation than if they weren't already wealthy. So if you're not working with millions of dollars from the start, it can make sense to take a more conservative approach to your portfolio than the 90 split that Buffett laid out. As a general rule, your age and your sleep well at night risk tolerance should impact your stock to bond ratio. Now, to show you what I mean, let's take a look at this great visual from Vanguard and use it as a guide. This visual shows that the younger the investor is and the longer their time horizon, the more they should favor stocks in their portfolio, such as the 90-10 split that Warren Buffett suggests. However, as you get closer to retirement, Vanguard suggests shifting more of your assets into bonds to dampen down the volatility of their portfolio, providing you with more income and stability during the period when you are more likely to be pulling assets out of your account. Now, the reason you should focus more on bonds over time is because of the variability of returns that these two asset classes deliver. Stocks have a much higher return, but they also have much higher volatility, whereas bonds have a more lower return, but they provide more day-to-day stability. Now, we can see that in action from this wonderful chart from Vanguard. What it shows is the range of calendar year returns over a 100-year period from different portfolios that constructed with 100% bonds all the way to 100% stocks. What we see is the portfolio on the right that has 100% stock exposure has a 10.2% nominal rate of return, but the variability of returns are very high, peaking at 54.2% on the upside and negative 43% on the downside. Conversely, a portfolio of 100% bonds and 0% stocks had a much lower overall return of just 5.1% nominally, but you can see that the range of returns at a calendar year was much more muted, at 32.6% on the plus side and negative 13% on the downside. This is why making your portfolio more conservative over time does make sense. Yes, you're lowering your portfolio's overall return, but you're also dampening down on the year-to-year volatility that you will experience. Now, once you've decided on your initial allocation, it's really important that you need to maintain it. This is where rebalancing comes in over time. About once a year, it's a good idea to adjust your portfolio back to your target ratio. Now, this often means selling a little bit of what's gone up, like stocks during a bull run, and buying more of what's gone down, like bonds during that same bull run. And the inverse is also true. This is a disciplined way to manage risk and capital, and can even help you buy low and sell high automatically with just 1 day of work per year. Now, even with this very simple and powerful strategy, there's one major mistake that can derail everything, and that is abandoning your plan during market downturns. When headlines are scary and your portfolio is down, it can be awfully tempting to sell. Now, this wonderful visual from JP Morgan Chase shows just how common double-digit drawdowns are even in calm years for the market. We can see that in more years than not, the S&P 500 will experience a intra-year decline of more than 10%. And sticking with your portfolio strategy during these periods can test the nerves of even the most experienced investor. That's why it's incredibly important to know yourself as an investor ahead of time and construct a portfolio allocation that fits your unique personality and circumstances. So to recap, the two-fund portfolio simplifies investing, it cuts costs, and it leverages the power of the entire market, letting time and compounding do the heavy lifting. And now that you have a clear, simple, and proven strategy that even Warren Buffett endorses, you can confidently build long-term wealth without needing to become a Wall Street expert yourself. Now, as a reminder, I made a few visual cheat sheets and put them into an ebook that spells out the exact ETF fund names you can use to recreate this portfolio yourself. If you want a free copy, just visit longtermmindset.co/ETF or click the link in the video description and let me know where to send it. Well, thanks so much for watching this video. If it was helpful, give it the thumbs up. That really helps us out on YouTube. And if you want to keep learning from here, I highly recommend you watch this video next.